Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly newsletter. Today's date is the 16th of June. Let's dive into the week's stock market news. European economies face headwinds amid global uncertainties. European stock markets experienced a downturn recently, with the Pan-European Stocks Europe 600 index falling by 1.57% in local currency terms. This decline was largely attributed to renewed uncertainties surrounding U.S. trade policy and escalating geopolitical tensions in the Middle East. Major individual stock indexes across the continent also registered losses, with Germany's DAX dropping 3.24%, Italy's FTSE MIB losing 2.86%, and France's CAC 40 index declining 1.54%. In contrast, the UK's FTSE 100 index remained relatively stable, showing little change. The United Kingdom's economy saw a contraction in April, as its gross domestic product GDP shrank by 0.3% sequentially, following a 0.2% growth in March. This marked the first decline in 5 months and the most significant since October 2023, primarily driven by downturns in the services and production sectors. Despite this monthly dip, GDP for the 3 months leading up to April still managed a 0.7% growth. Notably, exports of goods to the US in April plummeted by £2 billion, representing the largest monthly decrease on record since 1997. Concurrently, the UK's labour market showed further signs of cooling, a trend observed after recent increases in employer social security contributions and the minimum wage. Unemployment reached a 4-year high of 4.6% in the 3 months through April. Annual growth in private sector pay, excluding bonuses, a metric closely watched by the Bank of England, slowed to 5.2% over the period, marking its slowest pace since the third quarter of 2024. Across the Eurozone, industrial output faced challenges in April, contracting by 2.4% sequentially, a much larger decline than the 1.8% anticipated by analysts. The bloc's trade surplus also significantly shrank, falling to €9.9 billion in April from €37.3 billion in March, exceeding expectations for its contraction. Amid these economic indicators, officials from the European Central Bank (ECB), including President Christine Lagarde and Chief Economist Philip Lane, provided comments that fueled speculation about a potential pause in the ECB's easing cycle in July. Policymakers are reportedly assessing the economic impact of potential U.S. tariffs. Lagarde reiterated the ECB's confidence in having reached a good position to achieve medium-term inflation targets, characterizing the latest policy decision as well-calibrated. ECB has signaled a shift in its reaction function. Despite the central bank's forecasts for inflation and growth being more pessimistic than those in May, officials have hinted at being near the conclusion of the rate-cutting cycle. We believe that the threshold for future data surprises to trigger additional cuts is high, and he anticipates the ECB may lower borrowing costs only once or twice more. Now our insight into alternative markets, limited partners special. Understanding a new generation of private markets investors. The private markets are experiencing a significant transformation, moving beyond the traditional dominance of large institutions to embrace a new generation of diverse investors, including high-net-worth individuals, HNWIs, family offices, and even retail investors. This democratization is driven by technological advancements, regulatory changes, and innovative financial products that have lowered entry barriers. For instance, HNWIs accounted for approximately 16% of global private market capital commitments in 2024, up from 10% 5 years prior, and over 50% of global family offices now allocate to private equity or venture capital. This diversification of the investor base introduces complexities as these new entrants bring varied priorities regarding access, returns, liquidity, and operational sophistication. For many newer investors, access remains a key hurdle, though platforms are lowering minimum investment thresholds to as little as $50,000 in some cases, while also highlighting the need for investor education and transparent communication. Geographic access is also a factor, with global managers increasingly launching region-specific funds or partnering with local intermediaries to attract investors from emerging markets. Return expectations vary widely. Institutional investors often target 10 to 15% annualized returns in private equity or venture capital, while HNWIs may prioritize capital preservation, and retail investors sometimes hold unrealistic expectations. A 2025 Deloitte survey found that 62% of HNWIs cited diversification as a primary reason for investing in private markets, while only 45% of retail investors prioritized it, often focusing on headline returns. Liquidity presents another significant divergence, as newer investors are less patient than traditional institutions, driving the rise of secondary markets and semi-liquid structures, though these may come with higher fees or lower returns. Finally, the operational demands of private markets, such as due diligence and reporting, are being addressed by technology-driven solutions to simplify processes for HNWIs and retail investors, who often rely on advisors or platforms. For allocators and managers, the challenge is to balance the long-term nature of private markets with the diverse demands for flexibility. Key strategies include developing tailored products for different investor profiles, investing in investor education and transparency, leveraging technology to streamline access and operations, customizing offerings for regional needs, for example, Sharia-compliant structures, and integrating ESG considerations, which are a growing priority, especially for younger HNWIs and family offices. The continued diversification of the investor base brings both new capital and demands for greater flexibility and innovation, requiring managers to move beyond a one-size-fits-all approach to preserve the appeal of private markets for long-term wealth creation.
Thank you for listening to this episode of Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.